Hello and welcome back on Accounting Samjho. Today we'll understand accounting concepts, accounting standards and GST. So accounting is called the language of business. Accounting is not only associated with business but with everyone who is interested in keeping an account of monetary transactions. Bookkeeping and accountancy is an art of recording, classifying, and summarizing transactions of business concern in a systematic manner. Now, what is the importance of accounting concepts? Why it is needed? So, it gives the uniformity in presentation. It also gives the reliable financial statements. It also gives generally acceptable basis of measurement. It also gives proper information to all and it's valid and appropriate assumptions. Now we'll see all these accounting concepts. The basic accounting concepts are the ideas, the theory and practice of financial accounting and are broad working rules for all accounting activities which are enlarged by the accounting profession. Now some of these concepts are listed below. Let us see one by one all these concepts. So first is the business entity concept. The business entity concept states that for the purpose of maintaining the books of accounts, the business and the owner of the business are two separate entities. Here all the accounting transactions are recorded from the business point of view and not from the owner's point of view. Now for example, when the owner pays rupees 50,000 from personal saving into the business, in the books of accounts it is recorded as capital introduced and not a business income. The next is the money concept. This states that all those transactions are recorded in the books of accounts where money is involved. Now, for example, when the skilled employees improve business performance, then that time their talent is not recorded because it cannot be measured in the form of money. The next is the historical cost concept. This concept states that the cost of all assets are shown in the books of accounts at its original purchase value or acquisition cost. Now here we can give the example as if the machine is bought for rupees 6 lakhs, it is recorded at the cost of rupees 6 lakhs even if the market value later becomes 7 lakhs. आज के तारीख में अगर मशीन की कॉस्ट 7 lakhs भी हो तो भी it is not booked at 7 lakhs because it is bought at rupees 6 lakhs. The next is uniformity concept. The accounting information provided by the financial statements is used for making major decisions and conclusions. If the financial statements are made with the same accounting practices and principles, then it is easy to conclude and take the major decisions. When a company uses the straight line method of depreciation every year for machinery to maintain the consistency, it is the example of uniformity concept. Next is the conservatism concept. This concept asks the accountants to play safe while recording the transactions in the books of accounts. Here the emphasis is that if the profits are shown more than the actual, then it may lead to reduction in the capital of the company. It states that the losses, even may or may not occur, should be provided for, but the profits should be recorded only when it is realized. Now, for example, if the debtor of rupees 15,000 may not pay to whom we have made the sales, that customer becomes our debtor. If the customer is not ready to pay 15,000, so the business here creates a provision for doubtful debts even before the actual loss occurs. So that is the convertism concept. The next is the going concern concept. This concept states that a business is assumed to continue for foreseeable future. The business is a going concern. Now, for example, furniture purchased for office use is shown as asset and depreciated over years instead of treating full cost as immediate loss. When the furniture for the office is purchased, so it is depreciated every year and the depreciation amount is debited from the fixed assets value. So the immediate loss doesn't occur and it is treated as the depreciated asset. Realization concept. This concept requires that the revenue of the business should be accounted for only when it is realized. Thus, if the sales are made or services are rendered, they are accounted when they are rendered and not when the money is received. Here we can say when the shirts worth rupees 60,000 sold on the credit, they are treated as sales immediately, even if the payment is received later. हमने शर्ट तो बेच दिए बट वी नो दैट दे आर ऑन सोल्ड ऑन द क्रेडिट, सो द सेल्स आर बुक्ड immediately even if we know that the payment we will get later on. So that is the realization concept. The next is the accrual concept. As per this concept, the income or revenue is recorded when it is earned, but expenses are recorded when they are payable. One simple example we can say that when the salary for March is paid in the month of April, it is still recorded as expenses in the month of March. Expenses for the month of March are all booked even if they are paid in the month of April. That is the accrual concept. The next is the dual aspect concept. As per this concept, for every debit there has to be corresponding and equal credit. On this basis, the entire accounting double entry bookkeeping works. When Rahul starts his business with the cash of rupees 6 lakhs, business gets cash of rupees 6 lakhs, that is the debit effect. And at the same time, the business has to pay Rahul rupees 6 lakhs, that is the liability. So that is the credit effect. So from this concept, the basic accounting arises, that is capital plus liabilities is equal to assets. The next is the disclosure concept. This concept states that the financial position means balance sheet and the performance of the business, that means the income statement, should be provided honestly to the users. This information should be relevant, reliable, comparable, and should be understood by the concerned authorities. So, if a company is facing a major court case, in that case, the company must mention it in notes of accounts. The next is the materiality concept. This concept is exceptional to the concept of disclosure concept. Also, materiality is subjective in nature and an item material to one person may be immaterial to another person. Now here we can say a calculator costing rupees 500 may be treated as an expense instead of showing as an asset. The last is the matching concept. According to this concept, revenues during an accounting period are matched with expenses incurred during that period to earn the revenue during that period. Provisions are made for depreciation of fixed assets, bad debts, etc. Adjustment entries are passed for accrual incomes, outstanding, and prepaid expenses. All the expenses here paid during the period are not considered, but the expenses related to accounting period are only considered. So these were the concepts of accounting. Now next is the accounting standards. So why do we need the standards? So accounting standards are written rules, principles, policies and procedures issued by accounting regulatory bodies to ensure that financial statements are prepared and presented in a consistent, transparent and comparable manner. So why we need these accounting standards? So let's see the objectives. So it is to ensure uniformity in accounting practices. It is to enhance reliability and transparency of financial information. It is to protect interest of investors, creditors and other stakeholders. It is to improve comparability and financial statements. Also, it is to reduce variation in accounting treatment. Now, international financial reporting standards. This is a set of international accounting standards stating how a particular types of transactions and other events should be reported in financial statements. IFRS are issued to develop accounting standards that would be accepted worldwide and to improve financial reporting worldwide. Now in India, Standard of Accounting is issued by the Institute of Chartered Accountants of India, that is ICAI. Now we'll learn GST. GST is goods and service tax. So taxes are divided into direct taxes and indirect taxes. Income tax is the example of direct taxes which comes under direct taxes. Under indirect taxes we have state taxes and central taxes. Earlier we had VAT, octroi, luxury and entry tax under state taxes, and excise, custom, CST and service under central tax. Now all these were simplified and only one tax has been imposed by Government of India, that is GST, goods and service tax. Now interstate tax, that is within the state tax, that is IGST. Suppose the goods are sold from Nagpur to Dhule, so that is the interstate within the state tax. And intrastate, that is one state to another state, that is from for example from Maharashtra to Punjab, then the state is changed. So in that case CGST is levied by center and SGST is levied by the state. So why the GST was introduced? Let us see why it was introduced. So GST is basically one nation, one tax, one market. It started from 1st of July 2017. Now, all state and center taxes like VAT, octroi, luxury, entry, excise duty, custom duty, CST, and service tax are replaced by GST. GST is collected by the state where goods and services are consumed and not where they are produced. GST is divided into CGST, that is central GST, SGST, that is state GST, and IGST for interstate transactions. Now, this GST, all these compliances like registration, returns, payments, they are made all these compliances are online, that is paperless, and that is very user friendly for the users. This business can claim credit for GST paid on purchases used to make taxable suppliers. Now we'll see the advantages of GST. GST merges various indirect taxes into one and makes compliance easier. So it is the simplification of tax structure. Input tax credit avoids tax on tax, which results in reducing the tax burden. So it is the reduction in the cascading effect of taxes. It encourages transparency and compliance. Since all this registration, then making the payments, filing the returns, everything is online. A uniform tax system across India has reduced legal and logistic hurdles. This encourages automation and digital literacy. So the next advantage is it boosts ease of doing business. Lower cost due to tax credit leads to reduced price for consumers. So it promotes competitive pricing. And the last is more businesses are brought into the formal system due to compulsory GST registration. So these are the advantages of GST. Now recently the government of India has changed the tax slabs for GST. So for fresh fruits, vegetables, then milk, bread, then the LIC premium, then charitable education and healthcare services, individual and small scale essential goods, all these items are 0% tax. 5% GST rate is for soaps, shampoos, personal care products, fertilizers, pre-packaged snacks, namkeens, medical and diagnostic kits, tractor parts, and agriculture machinery. Now the recently 18% tax slab is for TVs, air conditions, fridge, small cars, certain engine capacity two-wheelers, then cement and building materials. The highest 40% slab is levied on tobacco products, cigarettes, pan masala, sugary drinks and luxury cars, etc. So today we have learned the basic concepts of accounting, then accounting standards and GST. Hope you like this video. Please do like, share and subscribe to this channel. Thank you so much for watching. Bye bye.